Nearly 70% of Ayala land's market value has vanished since 2019. On the surface, it looks disastrous. The top Philippine developer losing over half a trillion pesos in market capitalization. But look beneath the share price, and the story is far more complex. Ayala Land's business hasn't suffered a comparable collapse. In fact, since its peak, total assets have soared from 714 billion pesos to over a trillion. Equity and earnings are both higher than before the pandemic. By 2025, annual earnings topped 39 billion pesos, surpassing pre-pandemic levels. The engine is bigger, and the balance sheet is stronger, yet the share price tells a tale of steep decline. The reason lies not in what Ayala Land owns, but in how the market values time, risk, and execution. Investors once paid a premium, betting on rapid transformation of raw land into thriving communities, business hubs, and malls. In 2019, the market value was almost 4 times book equity. Optimism priced in layers of potential. Profit from new residences, rental streams, and the multiplier effect of each successful estate. Today, that premium is gone, replaced by a deep discount. Shares trade below book value. Investors now doubt how quickly those assets can be turned into cash, especially with slower sales and more expensive borrowing. Ayala Land's balance sheet is rich with land and developments, but cash and liquidity are limited. Much capital is tied up, waiting for demand to unlock its value. And with over 300 billion pesos in debt, patience is measurably more costly when interest rates rise and sales slow. These concerns were sharpened by recent results. First quarter 2026 saw revenue and earnings drop, margins weaken, and development income lag. It's not insolvency, but it's a stark warning. For a property developer, value doesn't lie just in what is owned, but in how, and how soon, it can be realized. Land is valuable. Cash is useful. The market knows the difference. Ayala Land's fundamentals remain sound. Assets and equity are up, liabilities have grown more slowly, and annual earnings are, in nominal terms, at record highs. But investors won't pay for distant possibilities if they doubt the timeline and cost of getting there. A recovery doesn't require exuberant valuations. Even a return to book value would be substantial. For that to happen, Ayala Land must demonstrate that stronger sales, better margins, and improving cash generation are sustainable, without relying on ever-expanding debt. Only then will confidence and valuation begin to recover. The land remains. The question is how long the market is willing to wait, and at what price, for its promise to be fulfilled.